Number 1. Definition and interpretation of Macaulay duration. What it is, Macaulay duration is the weighted average time in years until a bond's cash flows are received. Think of it like the center of mass of a seesaw. Each cash flow is a weight, and the distance from today is the lever arm. The balance point tells you the effective maturity of the bond. Formula derivation. List each cash flow CF sub t occurring at time t years, t equals 1, 2 through n. Discount each cash flow to today using the yield y. Present value PV sub t equals CF sub t divided by 1 plus y all raised to the t. Compute the bond price P equals the sum from t equals 1 to n of PV sub t. Assign a weight to each cash flow. W sub t equals PV sub t divided by P. The weight is the proportion of the bond's present value that each cash flow represents. Multiply each weight by its time t and sum. Macaulay duration d sub m equals the sum from t equals 1 to n of t times w sub t, which is also equal to the sum from t equals 1 to n of t times cf sub t divided by 1 plus y raised to t, all divided by the sum from t equals 1 to n of cf sub t divided by 1 plus y raised to t. Numerical example: a 5-year annual coupon bond, face value $1,000, coupon 6%, so $60 each year, yield to maturity 5%. Table of cash flows. At year 1, cash flow $60, present value $57.14. At year 2, cash flow $60, present value $54.42. At year 3, cash flow $60, present value $51.83. At year 4, cash flow $60, present value $49.36. At year 5, cash flow $1,060, present value $830.68. Bond price P equals 57.14 plus 54.42 plus 51.83 plus 49.36 plus 830.68 equals $1,043.43. Sum of T times present value equals $4,772.31. Thus D sub M equals 4,772.31 divided by 1,043.43 equals 4.57 years. The bond behaves as if all cash is received on average 4.57 years from now, a little less than its final maturity because most of the value is in the large payment at year 5. Interpretation: if interest rates change, a higher duration means a bigger price move. The Macaulay duration also tells you roughly how long you must hold a bond to earn its yield, assuming you reinvest coupons at the same yield. 2. Modified duration. Relationship to Macaulay duration, sensitivity approximation, and worked calculation. Why we need a new duration. Macaulay duration is measured in years, but investors care about the percentage price change for a 1% or 100 basis points change in yield. Modified duration translates the time-weighted measure into a direct price sensitivity measure. Relationship. D mod equals D sub m divided by open parenthesis, 1 plus y close parenthesis, where y is the yield per period expressed as a decimal. The denominator adjusts for the fact that a 1% rise in yield reduces the present value of each cash flow by roughly t times y. Sensitivity approximation. For a small change in yield delta y, delta p over p approximately equals negative d mod times delta y. The minus sign shows that price falls when yield rises. Worked calculation, same bond as before. Macaulay duration d sub m equals 4.57 years. Yield y equals 5% equals 0.05. D mod equals 4.57 divided by open parenthesis 1 plus 0.05 close parenthesis equals 4.57 divided by 1.05 equals 4.35. If the yield jumps from 5% to 6%, delta y equals 0.01. Delta p over p approximately equals negative 4.35 times 0.01 equals negative 0.0435. That is a 4.35% price decline. The actual price from a full revaluation drops from $1,043.43 to $998.31, a change of minus $45.12 or minus 4.33%, confirming the approximation is very close. Key takeaway: modified duration is the number you can multiply by a change in yield in decimals to estimate the percentage change in price. It is the primary risk measure used by portfolio managers. A zero-coupon bond. A zero-coupon bond pays a single lump sum at maturity, so all the cash flow weight sits at the final date. Macaulay duration equals maturity in years. Because there is only one cash flow, the weighted average is just that cash flow's time. Modified duration equals maturity divided by 1 plus y. Example: $1,000 face value, 10-year zero coupon, yield 4%. Price equals 1,000 divided by 1.04 to the 10th power equals 675.56. Macaulay duration equals 10 years. Modified duration equals 10 divided by 1.04 equals 9.62. If yield rises to 5%, delta y equals 0.01, estimated price change equals negative 9.62 times 0.01 equals negative 9.62%. New price equals 675.56 times 1 minus 0.0962 equals 609.5, which matches the exact price. 1,000 divided by 1.05 to the 10th power equals 613.9. Very closely. B. Fixed coupon bond, regular bond. Use the same steps as in topic 1, but we present a compact algorithm. Step 1. List cash flows, coupons each period plus principal at maturity. Step 2. Discount each cash flow at the current yield. Step 3. Compute weights. W sub t equals present value sub t divided by p. Step 4. Macaulay duration equals the sum of t times w sub t. Step 5. Modified duration equals d sub m divided by 1 plus y. Example: same 5-year 6% annual coupon bond, yield 5%, already solved. Recap. Macaulay equals 4.57 years. Modified equals 4.35 years. Zero coupon counterpart, 5-year 5% yield would have a duration of exactly 5 years Macaulay, and 4.76 years modified, showing that coupons pull the duration down because part of the cash arrives earlier. Practical insight: the more frequent the coupons or the higher the coupon rate, the shorter the duration, because you receive money sooner. This is why short-term high coupon bonds are less sensitive to interest rate moves than long-term low coupon bonds. Explanation. 4. Convexity. Mathematical definition, formula derivation, and sample calculation. Why duration alone is not enough. Duration gives a linear first-order estimate of price change, but the price-yield curve is curved. The true relationship is slightly convex. Convexity captures the second-order effect, improving the estimate especially for large yield moves. Mathematical definition. Convexity C is the second derivative of price with respect to yield, scaled by price. C equals 1 over P times the second derivative of P with respect to y squared. When we work with discrete cash flows, the formula becomes C equals 1 over P sum from T equals 1 to n of T times open parenthesis T plus 1 close parenthesis times C f sub T divided by open parenthesis 1 plus y close parenthesis to the power of T plus 2. If the yield is per period and cash flows are annual, the plus 2 in the denominator adjusts for the second derivative. Derivation sketch. Start from price P equals sum of C f sub T divided by open parenthesis 1 plus y close parenthesis to the power of T. First derivative, partial P partial y equals negative sum of T times C f sub T divided by open parenthesis 1 plus y close parenthesis to the power of T plus 1. Second derivative, partial squared P partial y squared equals sum of T times open parenthesis T plus 1 close parenthesis times C f sub T divided by open parenthesis 1 plus y close parenthesis to the power of T plus 2. Divide by P to obtain the dimensionless convexity measure. Sample calculation. Use the 5-year 6% coupon bond, yield 5%. First compute each term. T times open parenthesis T plus 1 close parenthesis times C f sub T divided by open parenthesis 1.05 close parenthesis to the power of T plus 2. Table columns. T C f sub T, T times open parenthesis T plus 1 close parenthesis. Numerator T times open parenthesis T plus 1 close parenthesis C f sub T. Denominator open parenthesis 1.05 close parenthesis to the power of T plus 2 term. For t equals 1, cash flow 60, t times t plus 1 equals 2, numerator 120, denominator 1.05 cubed equals 1.1576, term 103.7. For t equals 2, cash flow 60, t times t plus 1 equals 6, numerator 360, denominator 1.05 to the fourth power equals 1.2155, term 296.2. For t equals 3, cash flow 60, t times t plus 1 equals 12, numerator 720, denominator 1.05 to the fifth power equals 1.2763, term 564.5. For t equals 4, cash flow 60, t times t plus 1 equals 20, numerator 1200, denominator 1.05 to the sixth power equals 1.3401, term 895.4. For t equals 5, cash flow 1060, t times t plus 1 equals 30, numerator 31,800, denominator 1.05 to the seventh power equals 1.4071, term 22,603.6. Sum of terms equals 24,463.4. Bond price P equals 1,043.43. Convexity C equals 24,463.4 divided by 1,043.43 equals 23.45. Often we report annual convexity, so we divide by open parenthesis 1 plus y close parenthesis squared again, giving about 21.3. The unit is years squared. Larger convexity means the price falls less when yields rise and rises more when yields fall, a desirable property. Takeaway: convexity refines the duration estimate. In practice, portfolio managers look for bonds with high convexity for a given duration because they provide better price protection. Explanation: 5. Price change approximation using duration and convexity. Delta P approximately minus D times delta Y plus 1/2 C times delta Y squared with practice problem. The formula, delta P over P approximately minus D sub mod times delta Y plus 1/2 C times delta Y squared. The first term, duration, gives the linear effect. The second term, convexity, adds curvature. Because C is positive, the price loss from a rise in yield is slightly smaller than the duration-only estimate, and the price gain from a fall is slightly larger. Practice problem. A 7-year bond pays an 8% annual coupon, face $1,000. Current yield 6%. Its modified duration is 5.2 and its convexity is 45 years squared. Estimate the price change if the yield jumps to 7%, delta Y equals plus 0.01. A solution. Step 1. Plug values into the formula. Delta P over P approximately minus 5.2 times 0.0, 1 plus 0.5 times 45 times 0.01 squared. Step 2. Compute each part. Duration effect. Negative 5.2 times 0.01 equals negative 0.052, which is minus 5.2%. Convexity effect. 0.5 times 45 times 0001 equals 0.00225, which is plus 0.225%. Step 3. Total approximately negative 0.052 plus 0.00225 equals negative 0.04975, or minus 4.975%. Step 4. If the current market price is $1,080, the estimated new price equals $1,080 times 1 minus 0.04975, approximately $1,029. Step 5. A full revaluation discount each cash flow at 7% gives $1,027. The approximation is extremely close. Interpretation. The convexity terms soften the price decline by about 0.2%, showing the protective effect of convexity. When to use? Use the two-term approximation for yield moves up to roughly 100 basis points. For larger moves, higher order terms become noticeable, but the formula remains a valuable quick-check tool for portfolio risk monitoring. Goal: build a bond portfolio whose value at a future horizon, for example 5 years, is insensitive to small changes in interest rates. This is called immunization. Key conditions. 1. Present value match. The market value of assets, the bond portfolio, equals the present value of the liability. the cash needed at the horizon discounted at the current yield. 2. Duration match. The Macaulay duration of the asset portfolio equals the investment horizon, the time until the liability is due. 3. Convexity optional. If you also match convexity, the immunization holds for larger yield changes. Why it works. A proof sketch. Let PA of Y be the price of the asset portfolio, and L the liability amount due at time t. Present value condition. PA of Y sub 0 equals L divided by 1 plus Y sub 0 raised to the t. Take a small change in yield delta Y using a first-order Taylor expansion. PA of Y sub 0 plus delta Y approximately equals PA of Y sub 0 minus D, a times PA of Y sub 0 times delta Y. L divided by 1 plus Y sub 0 plus delta Y raised to the t approximately equals L divided by 1 plus Y sub 0 raised to the t minus t times L divided by 1 plus Y sub 0 raised to the t plus 1 times delta Y. If dA equals t, duration match, and the present value condition holds, the delta Y terms cancel, leaving the asset value approximately equal to the liability value for any small delta Y. Hence, the portfolio is immunized against small rate shifts. Illustrative example. Liability $10,000 due in 3 years. Current yield curve, flat at 5%. 1. Present value of liability. Present value equals 10,000 divided by 1.05 cubed equals 8,638. 2. Choose 2 bonds to meet the conditions. Bond A, 2-year 0 coupon, face $5,000. Price equals 5,000 divided by 1.05 squared equals 4,535. Duration equals 2 years. Bond B, 5-year 6% annual coupon, face $5,000. Compute price approximately 5,432 and Macaulay duration approximately 4.3 years. 3. Allocate amounts X and 1 minus X such that market value. X times 4,535 plus 1 minus X times 5,432 equals 8,638. Portfolio duration. Numerator X times 4,535 times 2 plus 1 minus X times 5,432 times 4.3 divided by 8,638 equals 3. Solving gives X approximately 0.63, 63% in the 2-year 0, 37% in the 5-year coupon. 4. Verify. If yield rises to 6%, reprice both bonds and compute new portfolio value. The change is only about -$30, negative 0.35%, while the liability's present value falls by -$260, showing the portfolio largely offsets the rate move. It is immunized. Practical tip: in real life, immunization is often performed with a duration-matched bond index fund or a combination of treasury securities, because exact cash flow matching dedication may be costly. Limitations: immunization protects only against small parallel shifts. Large or non-parallel moves can break the hedge unless convexity is also matched. Effective yield curve shifts on duration and convexity. Parallel versus non-parallel shifts with sample scenarios. Parallel shift: every point on the yield curve moves by the same amount. For example, all yields rise from 4% to 5%. In this case, the modified duration and convexity, calculated with a single flat yield, remain good approximations of the portfolio's price sensitivity. Non-parallel twist shift: short-term rates move differently from long-term rates. Because each cash flow is discounted at its own spot rate, the effective duration changes. Scenario 1, parallel 100 basis points increase. Bond 10-year annual coupon 5%, face $1,000, current flat yield 4%. Modified duration approximately 7.8, and convexity approximately 70. Using the duration convexity formula, price change approximately open parenthesis negative 7.8 times 0.0, 1 plus 0.5 times 70 times 0.000, 1 close parenthesis equals negative 7.8% plus 0.35% equals negative 7.45%. Full revaluation gives a price drop of about negative 7.48%, confirming the approximation. Scenario 2, twist: short rates plus 50 basis points, long rates minus 30 basis points. Assume the 2-year spot rises to 4.5%, while the 10-year spot falls to 3.7%. Discount each cash flow at its new spot rate. Early coupons are now heavier, higher discount, and later coupons lighter. Effective duration shrinks because more weight moves to later cash flows, they are discounted less. Ray calculating gives a modified duration of about 7.2, down from 7.8. Convexity also changes, generally rises when the curve flattens, now about 75. The price impact using the original duration convexity numbers would overstate the loss. The true price change is closer to negative 6.9%. Takeaway: parallel shift analysis is simple and works well for short-term risk reports. For portfolios exposed to steepening or flattening, for example mortgage-backed securities, you must recompute duration and convexity with the shifted spot curve or use key rate duration, sensitivity to individual maturities to capture non-parallel effects. Key rate duration example: compute duration with respect to the 2-year rate while keeping others fixed. Then repeat for the 5-year, 10-year rates. The portfolio's total change is the sum of the individual key rate impacts, allowing managers to see which part of the curve drives risk. 8. Typical MBA exam questions on duration and convexity. Multiple choice, short answer, and computational problems. Multiple choice example. A 4-year bond pays an annual coupon of 6% on a $1,000 face value. Yield equals 5%. Which of the following is closest to the bond's modified duration? A 3.2, B 3.5, C 3.8, D 4.1. Answer C. Using the Macaulay duration approximately 4.0 years. Divide by 1.05 yields 3.8. Short answer example. Define convexity and explain why a higher convexity is desirable for a bond portfolio. Convexity is the second-order sensitivity of a bond's price to changes in yield, measured as C equals 1 over P times the second partial derivative of price with respect to yield squared. A higher convexity means the price falls less when yields rise and rises more when yields fall, giving the portfolio a curved price-yield relationship that provides extra protection against large rate moves. Computational problem. You manage a $5 million portfolio consisting of 2 bonds. Bond X, 3-year 0 coupon, face $10,000, yield 4%. Bond Y, 7-year 8% annual coupon, face $10,000, yield 4%. The portfolio is to be immunized against a liability of $5.2 million due in 5 years. Part A. Determine the market value of each bond. Part B. Find the proportion of each bond needed so that the portfolio's duration equals 5 years, and its market value equals the present value of the liability. Part C. Compute the portfolio's convexity. A solution sketch. Part A. Price of X equals 10,000 divided by 1.04 to the third power equals $8,889. Price of Y equals present value of coupons plus principal, approximately $9,734. Part B. Let W be weight on X present value condition. W times 8,889 plus open parenthesis 1 minus W close parenthesis times 9,734 equals 5,200,000 divided by 1.04 to the fifth power equals 4,058,000. Duration of X equals 3, duration of Y approximately 6.2, computed via Macaulay. Duration equation. The numerator W times 8,889 times 3 plus open parenthesis 1 minus W close parenthesis times 9,734 times 6.2 divided by 4,058,000 equals 5. Solving gives W approximately 0.68, 68% in X, 32% in Y. Part C. Compute convexity of each bond using C equals the sum of T times open parenthesis T plus 1 close parenthesis times cash flow T divided by 1.04 to the T plus 2, all over price P, then combine with same weights. Result approximately 30 years squared. Exam-style tip sheet. Remember, Macaulay equals weighted average time. Modified equals Macaulay divided by 1 plus yield. Convexity formula adds a T times open parenthesis T plus 1 close parenthesis term. For immunization, write down the 2 equations, present value match and duration match, and solve simultaneously. When a question mentions a parallel shift of 50 basis points, use the delta P approximately minus duration times delta Y plus 1/2 convexity times delta Y squared formula. Key rate duration questions will list delta y 2-year equals plus 0.2%. Treat each as a separate